Welcome back, investors. Jake here. In this video, let's check in with the stock market as last week was not a good week. On Friday, the S&P closed down 2.9%, Dow Jones down 2.7, Nasdaq down 3.5, and the obvious explanation for why the market sold off on Thursday and Friday is the inflation number. This is the consumer price index number, came in for the month of May. It was measured at 8.6% year over year. This is the highest rate of inflation the United States has seen since 1981. So we definitely have a problem, and this number of 8.6% isn't really accurate for what the average American is paying in inflation costs. Case in point, gas prices are up nearly 50% year over year. Energy prices across the board for everyone are up year over year by greater than 8%. And even if you drive a Tesla and you have an electric car, you're still paying this inflationary price for gasoline, as every company in the S&P 500 has trucks and vans, and they're still paying for gasoline. And either they lose profit margins or they pass the price of increased fuels onto their customers. So everyone is paying this increased price for basically everything they buy currently. Here's an article titled, "The more gasoline rises above $5, the greater the risk there is of a recession." This plan we've been sold by the Fed of a soft landing where we can raise interest rates to get inflation under control without triggering a recession. Even under the best of conditions, that's suspect if the Fed could even do it, but given all the other crazy things happening in the world right now, the chance of not having a recession this year or next year, in my opinion, is basically zero. So let's now pivot and look at the charts first before we talk about what can the Fed potentially do over the next 2 weeks. And I've been showing you this chart every video basically. This is the S&P 500. The market peaked on January 4th with an S&P value of 4,800. However, the market for almost 6 months now has been locked in this down channel from a technical perspective. On the low end of this channel, there's 1, 2, 3, 4 points of contact, which is pretty strong. I realize you can draw these lines however you want to draw them and see however you want to see them. But with 4 points of contact, I feel like potentially we're going to hit the bottom of this range again pretty soon. Now, I was watching the market for almost 2 weeks when the S&P was at about 4,100. And I wanted to sell out of some positions in my Schwab accounts. I wanted to potentially short the market or buy some puts. But I was being greedy, and I was hoping the market could potentially get to this upper range slope line. That didn't happen, and we've got 2 huge red candles here basically laughing at me. So the Federal Reserve is meeting on Tuesday and Wednesday of next week. We're going to know what the next Fed rate hike will be, whether it's 50 basis points or 100 basis points. And the market's going to go one of 2 directions. If the Fed is reassuring and comforting and Jay Powell can sweet talk everyone, then I think the market potentially could get back to this 4,100 range, but that's being optimistic. More than likely, I think the market is just going to keep selling off next week, and then we'll hit the bottom end of this range and then potentially drift back to the middle of it by early July. However, I do want to say that even though I'm down massively in all of my accounts as my options plays basically have been annihilated, I am still seeing tremendous opportunity with this sell-off in the market. Look at these drops just for this week. This is the 1 week performance of the S&P 500. This is the heat map. Amazon down 10% just this week. JP Morgan down 8%. Microsoft down 6%, Nvidia down 9%, Adobe, one of the greatest companies in the world, down 8%. The only sector that was green this week, surprise, surprise, was oil and gas. So where I'm going with this is I've been saving my money. I've actually not added any money to any of my accounts so far for 2022, and I've been building a cash position. My goal is to leverage pretty hard on call contracts potentially for 2024 or 2025 once I feel like the market is done selling off. And I don't think we're there. Year to date, the market, the S&P is down 18%. So even as painful as this has been for everyone the last 6 months, we're not even in bear market territory yet. The S&P can definitely go much lower. Here's the chart I've been showing you in my update videos. This is the 5-year chart for the S&P 500. Each one of these candles represents a week. And the last time the Fed was raising interest rates that kind of triggered a sell-off, this was in 2018. The S&P dropped to the 200-week moving average. Sure enough, with the COVID scare, the market dropped below the 200-week moving average. So we're not there. The 200-week moving average is slowly drifting up. It's currently at a value of 3,500, but the market still has to drop. And my prediction that I'm going to repeat in every one of these videos is at some point this year. Could be next week, could be a month from now, could be in November or December, but the S&P and this 200-week moving average are going to converge. They're going to touch. Maybe even the S&P will go below it. But that's my signal basically to buy into the market, to go all in. I'm going to be looking at January 2025 call contracts on the S&P. They should be available in September. And I'm going to leverage pretty hard that over the next 3 years, the economy and the market will recover and get back to all-time highs. But in the short term, next month, this is going to be brutal. So all of the big tech companies are reporting this week in July. Apple is reporting on July 27th. And what's been happening the last 6 months is the multiples for all of these companies have been contracting. So the most famous one is price to earnings, but there's also price to sales, price to free cash flow, price to book value. These multiples are useful for comparing companies against each other, comparing companies within their sector, understanding if potentially you're overpaying for a company. So how do you calculate price to earnings? You take the total earnings of the company, millions or billions or whatever, divide it by the number of shares in existence, whether it's 10 million shares, 100 million shares, whatever. This gives you your EPS, the earnings per share. You then take the share price of the company, whatever it is, and divide it by your EPS. This gives you the P/E ratio, and this is the most well-known of the multiples. So when we go to, for example, Apple, this is macrotrends.net, the multiples of Apple have been contracting. So 2 quarters ago, the P/E was 29, but Apple has sold off, I think, greater than 20%. So the multiple has been contracting, making the value more attractive. It's down to 23. The problem with these ratios, though, is the historical valuation of Apple has been in the teens. 13, 10, 15, 18, 20 might be the max. So potentially, the multiple still has to contract for Apple. The problem that I need to warn you guys about is that these multiples are contracting based on good earnings. Apple, Microsoft, all these other companies, the last 3 or 4 quarters have had fantastic earnings. They've been doing well. What's going to happen when a true recession is triggered and their earnings fall? So this sell-off that we've been seeing in all the companies is the first contraction of the multiples down to a more reasonable number. But a second drop, a second contraction is going to come when the earnings of these companies dip when their EPS goes down. So I think a lot of these big tech companies that are fantastic companies in the short term are going to experience massive contractions in their valuations. Microsoft is another example. Just 2 quarters ago, their PDE was 35. It's been contracting, but it's been contracting based on good earnings. What happens when Microsoft doesn't have a good quarter? So this is going to annihilate all of the indexes, annihilate, the Nasdaq and the S&P, because these mega caps like Apple and Microsoft are so big. But this drop is coming. As soon as they have a quarter where earnings slow or contract, it's going to be a bad day for the market. So let's now pivot and talk about Jay Powell and what the Fed can really do. And I'm first going to express my frustration with the Fed that they didn't start raising interest rates sooner. Because when you look at the CPI number going back to a year ago, so this is June of 2021, CPI was already above 5%. It was at 5.4. And the Fed was feeding us BS, basically, that inflation was transitory and supply chain issues would resolve themselves and magically inflation would go back down. Hindsight is 2020, but yeah, the Fed should have started raising rates aggressively a year ago, basically, to avoid the problem we're currently in. So can the Fed achieve a soft landing? They did it in the early 90s. They raised interest rates to get inflation under control. It didn't trigger a recession. There was no recession in the United States in the mid-90s. I don't think so, because there's so many things that the Fed can't control, and the Fed wasn't planning for a year ago. Case in point, if the Fed raises interest rates, how does this resolve supply chain issues with China? China is still struggling with COVID as the vaccines they've domestically produced are terrible and they refuse to accept mRNA vaccines from the West. And even today, even this week, new COVID lockdowns are occurring in Beijing and Shanghai, disrupting production and manufacturing for all of these companies. Additionally, this crazy war with Russia and Ukraine, it's going to get worse because the global food shortage is coming. Not only can Ukraine not get their exports out for what they've already grown, 20% of the country is now occupied by Russia, and farmers aren't farming. It's a war zone. So food prices around the world are going to skyrocket as Ukraine's grain exports alone fed close to 400 million people. So this food shortage is going to be bad. And it's going to affect even us here in the United States because it'll affect the price of meat. If there's not enough grain to feed all the people in the world, then there's definitely not enough grain to feed all the animals that we enjoy eating. So if you like burgers, if you like steaks, I'm sorry, but tremendous price increases, especially for beef, are coming, and there's nothing we can do, and there's nothing the Federal Reserve can do until Russia basically gives up on this war. The only other tool available to the Fed, aside from raising interest rates aggressively, is to basically unload their balance sheets. What you're looking at here is when you hear the expression the Fed is printing money, what they do is they buy US Treasuries. They buy government debt, add it to their books. They basically invented this money out of nothing in order to hold and buy all these treasuries. But at any time, they can dump those treasuries back on the market, causing bond yields to rise as there's more supply than demand. And the interest rates have to increase, the yield rates have to increase in order to attract bond buyers. And the Fed's done this a little bit. You can see that in April, their balance sheet peaked, and then they basically unloaded maybe a couple $1 billion worth of treasuries. But look at this increase in response to COVID. Their balance sheet went from $4 trillion to $7 trillion. What would happen if the Fed just dumped $3 trillion worth of treasury bonds on the markets The yield, I have no, they wouldn't do that because that's insane. But the 10-year Treasury yield has been increasing. This is the risk-free yield you can get on your money, basically a guarantee. And the yield was, at the beginning of the year, 1.5%, and it's doubled in 6 months. This is because the Fed is no longer buying bonds, but now they're starting to dump them on the market. And the more they flood the market, the higher this yield will go up, the more it'll attract investors from stocks and equities, investors from real estate, investors from crypto, whatever. So all those other asset classes go down in response. Okay, let's go back to the charts for the S&P 500. I've already given you my case that potentially we're going to hit the bottom of this range next week, but I don't know, the Fed could say or do something magical next week and investors are reassured and we could potentially get back to 4,100. Either way, I still don't like where we are. I don't think this market has bottomed. I'm still looking at this heat map of fantastic companies that are selling off huge, and as long as you've got some cash reserves, you've got a secure job, you've got an income, I would just hold on to your money and prepare to buy the dip potentially later this year when the market does finally bottom out. Okay, everyone, that's all for this update video. If you found it informative, give me a thumbs up. Really helps out with the channel. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.